I nearly fell off my chair when I discovered my friend and I were charged differently for the same subscription service. After digging deeper, I uncovered an entire network of AI systems designed to charge me more based on my zip code, browsing habits, and even the type of phone I use. This discovery sent me on a 6-month investigation into how AI manipulates our financial lives. What I found was so shocking that I had to create this video to warn you about what's happening behind the screens of every financial app on your phone. The puzzling price difference. I was hanging out with my roommate last week when something caught my attention. We were both signing up for the same streaming service, and I noticed her screen showed $9.99 per month while mine displayed $14.99. At first, I thought she'd found a special promotion or was signing up for a more basic plan. But when we compared our screens side by side, it was the exact same subscription tier with identical features. Confused, I asked if she had a student discount or loyalty reward I didn't know about. Nope. We even checked to make sure we were on the official website and not some sketchy lookalike. Everything matched up perfectly, except for that $5 price difference. This wasn't making any sense. So we decided to try a little experiment. I logged out of my account and used her laptop to visit the streaming site. Suddenly, I was seeing the $9.99 price too. Then she used my phone and like magic, the price jumped to $14.99 for her as well. It wasn't the account that was getting different prices, it was the device. This got me thinking. What if this wasn't a random glitch but something intentional? I started researching and discovered this practice has a name: dynamic pricing. Companies use sophisticated AI systems that analyze dozens of data points about you in real time to determine the maximum price you might be willing to pay. The more I looked into it, the more examples I found. I tested this theory by shopping for the same wireless earbuds on different devices. On my regular laptop, they were priced at $129, but when I checked from a brand new browser with no history on my work computer, they were $109. Same exact product, same day, same zip code, just different digital profiles. What's happening here is that retailers and service providers are using artificial intelligence to create what they call personalized pricing. But let's call it what it really is: charging different people different amounts for identical products based on what an algorithm thinks they'll pay. These pricing algorithms consider factors you might expect, like your location and previous purchases. But they also analyze things you'd never imagine, like how fast you scroll through pages, what time of day you typically shop, whether you comparison shop or buy immediately, and even the battery level on your device. Some research suggests low battery levels correlate with more impulsive purchasing decisions, so you might see higher prices when your phone is about to die. And it's not just happening with streaming services or online shopping. This practice has spread across nearly every industry. Airlines have been doing this for years, but now it's happening with insurance quotes, hotel rooms, ride shares, food delivery apps, and even basic necessities. What makes this particularly concerning is how invisible it is. There's no notification telling you, hey, we've analyzed your data and determined you'll pay $5 more than someone else. Instead, you're shown a price that seems like the standard rate, with no way to know you're paying a premium. This AI-driven pricing works through a complex system of algorithms that track your digital footprint across the internet. When you visit a website, the AI can instantly access your browser type, operating system, and device information. But it doesn't stop there. If you're logged into an account, it can access your purchase history, browsing patterns, and how much you've been willing to pay in the past. The algorithm then compares your profile against millions of others to predict your price sensitivity. Are you someone who compares prices across multiple sites before buying? The AI might offer you a lower price to prevent you from shopping elsewhere. Do you typically buy items immediately after viewing them? You might get shown higher prices because the algorithm has tagged you as less price sensitive. Even more disturbing is how these systems can learn from your behavior. If you consistently accept higher prices, the algorithm remembers this and may continue testing even higher price points on you over time. Your digital shadow, the data trail you never knew you left. The shadowy data trail we leave behind online is far more extensive than most of us realize. Think you're just checking your account balance or browsing for a new credit card? Behind the scenes, you're actually generating a novel's worth of personal information every single day. The average person unknowingly leaves behind 80 megabytes of personal data daily, equivalent to about 40,000 pages of text, and financial companies are silently collecting every byte. I used to think my financial browsing was relatively private. That changed when I requested my personal data from 3 major financial apps I regularly use. What came back shocked me. Not only did these companies have records of every transaction I'd ever made, but they'd been tracking patterns I never considered. How long I spent viewing different investment options, which parts of my budget I reviewed most frequently, and even how quickly I scrolled through those terms and conditions I admittedly never read. Every single interaction you have with financial websites and apps creates valuable data points. When you hesitate before finalizing a purchase, that pause gets recorded. When you repeatedly check the details of a particular credit card offer, that interest is noted. Even the speed at which you type information into forms becomes part of your digital profile. None of these actions feel particularly revealing in the moment, but together, they create a comprehensive picture of your financial behavior. What's particularly concerning is that these seemingly unrelated activities are now being used to build surprisingly accurate profiles about your spending habits, risk tolerance, and financial decision-making. The Consumer Financial Protection Bureau has recently warned that these AI-marketed technologies can negatively impact civil rights, fair competition, and consumer protection. That's because these systems don't just record your actions, they make judgments about who you are financially. Companies aren't just watching what you do on their own platforms either. Through sophisticated digital fingerprinting techniques, financial institutions can track your activity across multiple websites and devices. This cross-platform tracking means that your activity on social media might influence the credit card offers you see, or your online shopping habits could affect the investment options presented to you. The information being collected goes far beyond what most people would expect or consent to if asked directly. Financial algorithms are now monitoring environmental context clues, like whether you're shopping late at night, which might indicate impulsive spending tendencies, or if you're browsing from a coffee shop versus your home, which might suggest different levels of financial caution. When I dug deeper into the data these companies had collected, I found they knew my exact location patterns, where I typically check my banking app, which neighborhoods I tend to spend money in, and even which financial decisions I make from home versus work. They had built complex models of my typical spending cycles and could predict with surprising accuracy when I was likely to make larger purchases. What makes this data collection particularly valuable to companies is that it's happening continuously, in real time, creating an ever-evolving profile of your financial self. Unlike a credit report that updates monthly, this shadow profile adjusts with every click and every second you spend on financial platforms. But why should you care? Because this data doesn't just sit in a database, it actively shapes your financial options. Financial institutions use these profiles to determine everything from the interest rates you're offered to the investment opportunities you're shown. And unlike traditional financial assessments that follow regulated guidelines, these algorithmic judgments happen behind closed doors with little transparency or oversight. The real cost: calculating your AI tax. Those hidden algorithmic judgments aren't just limiting your options, they're literally taking money from your wallet. There's actually a term for this invisible premium we're all paying: the AI tax. It's not a government fee or an official line item on your receipt, but it's costing you real money nonetheless. My 6-month experiment tracking identical purchases across different devices and user profiles revealed price differences that would shock even the most skeptical consumer. Let me break this down with some hard numbers. The average person loses between $1,200 and $1,800 every year to AI-driven price discrimination. That's about $100 to $150 monthly that silently disappears from your budget simply because algorithms decided you could afford to pay more. During my experiment, I created multiple online profiles with different browsing histories and purchasing patterns. The results were eye-opening. When I searched for flights using a profile that had previously browsed luxury hotels, the same exact seat cost nearly $200 more than when I used a budget traveler profile. This wasn't a one-time fluke, it happened consistently across different airlines and routes. The travel industry is particularly aggressive with these practices. That dream vacation you've been researching for weeks, the more you search for it, the more the algorithm recognizes your interest and adjusts prices upward. Those special deals might actually be costing you more than someone seeing the same flight for the first time. Insurance is another major culprit. During my research, I found identical auto insurance policies with premium differences of over $300 annually based on factors completely unrelated to driving history. The AI pricing algorithms in the insurance sector segment customers into different pricing tiers based on subtle signals in your data, like your zip code or even your online shopping behavior. Perhaps most disturbing was what I discovered in lending practices. The rise of AI in this sector has resulted in algorithmic discrimination, where certain demographics, particularly those from lower income backgrounds or minority groups, are charged higher interest rates compared to higher income customers with similar credit profiles. A seemingly small 0.5% difference in a mortgage rate can translate to tens of thousands of dollars over the life of the loan. Even everyday purchases aren't immune. When I asked viewers to document their experiences, the responses were overwhelming. One viewer in Chicago found she was consistently charged 15 to 20% more for ride-sharing services than her husband, despite requesting rides from the same location to the same destination. Another discovered that ordering the same grocery items through different accounts resulted in price variations of up to 10%. The financial services industry is particularly invested in these practices. They analyze your consumer data to segment you into different customer tiers, which determines everything from the fees you're charged to the interest rates you're offered. And unlike traditional financial assessments that follow regulated guidelines, these algorithmic judgments happen with little transparency or oversight. What makes this AI tax so insidious is how the small differences compound over time. An extra $5 here and $10 there might not seem significant in the moment, but these small increases accumulate into substantial financial impacts. Consumer reports consistently show that most people are completely unaware they're paying these premiums. So which industries are the worst offenders? Travel consistently tops the list, followed by insurance, financial services, and e-commerce. But the practice is expanding rapidly into other sectors like healthcare, education, and even basic utilities. The invisible filter: how AI decides what financial options you see. While travel companies might charge you more based on your search history, financial institutions are playing an even more disturbing game with your money. Have you ever wondered why you and your friend with similar credit scores receive completely different credit card offers? It's not coincidence, it's algorithmic discrimination happening behind the scenes. Let me take you behind the digital curtain where financial institutions decide which products you're allowed to see. Imagine it as a store where different customers are escorted to entirely different sections based not on what they need, but on what an algorithm thinks they deserve. This filtering system works much differently than simple price adjustments. Instead of just charging you more for the same product, these algorithms completely hide certain financial options from your view. You can't choose a better credit card if you never know it exists in the first place. I wanted to see this filtering in action, so I conducted an experiment. I created several digital profiles with identical financial qualifications, same income, same credit score, same employment history, but with very different browsing patterns. The results were shocking. The profile that had previously searched for budget travel and discount shopping was shown credit card options with interest rates at averaging 22%, annual fees, and minimal rewards. Meanwhile, the profile that had browsed luxury brands and investment sites was presented with premium cards offering 0% introductory rates, generous rewards programs, and lower long-term interest rates. Remember, these profiles had identical financial qualifications. The only difference was their digital footprint. What's particularly concerning is how these algorithms analyze factors that have nothing to do with your actual creditworthiness. Your zip code, for instance, can significantly impact which financial products you see. If you live in a neighborhood that the algorithm has coded as less desirable, you might only see higher interest loans and basic banking products. Even more invasive, these systems analyze your social connections. If your online behavior links you to people who have defaulted on loans or who use certain financial services, the algorithm may categorize you as higher risk, regardless of your own perfect payment history. This is what experts call digital redlining, a modern version of the discriminatory practice where certain neighborhoods were denied financial services. Only now, the red lines are invisible, drawn through your digital behavior rather than your physical address. These filtering systems create what we might call financial filter bubbles. Just like social media algorithms that show you news that confirms your existing beliefs, financial algorithms only show you products they've decided are appropriate for someone like you. Over time, this can significantly limit your financial opportunities. Think about what happens when someone only sees high-interest credit cards for years. They might accept those terms as normal, never realizing that others with similar financial profiles are accessing much better options. The extra interest they pay over time could prevent them from building wealth or investing effectively. The most troubling aspect is how these filters can reinforce existing inequalities. If you're already in a disadvantaged financial position, these algorithms may keep showing you financial products that keep you there. Higher interest rates, more fees, fewer opportunities to build credit. Looking at my experiment results, I found that the profiles with browsing histories typical of lower-income consumers were shown financial products that would cost them an average of $300 more per year in fees and interest than those shown to profiles with wealthier browsing patterns. What's worse is that once you're placed in one of these categories, it can be extremely difficult to break out. The algorithm continues to show you similar options, creating a feedback loop that reinforces your financial position. The illusion of personalized investment advice. Breaking free from algorithmic categorization gets even harder when you enter the world of digital investment advice. Ever wondered why your robo-advisor keeps suggesting those particular funds? The AI behind your personalized investment strategy often serves two masters, and your financial growth rarely comes first. Let's be honest about what's happening with these seemingly helpful financial tools. Robo-advisors market themselves as revolutionary platforms offering sophisticated investment advice that was once only available to the wealthy. Get personalized portfolio management at a fraction of the traditional cost they promise. The pitch is compelling: algorithmic investing that's tailored just for you, based on your goals and risk tolerance, all without the high fees of human advisors. But here's what's really going on behind that sleek interface. When I analyzed several popular robo-advisor platforms, I noticed something interesting. The personalized recommendations had a suspicious pattern. The AI consistently steered users toward proprietary investment products rather than truly independent options that might actually perform better. This isn't accidental. These platforms are designed with two competing objectives, helping you grow your money and generating revenue for the company. Guess which one usually wins? A study of robo-advisor recommendations found that they frequently push their own proprietary funds with higher expense ratios compared to independent alternatives. These higher fees might seem small, maybe 0.3% versus 0.1% for a comparable independent fund, but they add up to thousands of dollars of lost returns over your investment lifetime. Think about the last time you signed up for a robo-advisor. Remember that questionnaire about your risk tolerance? I conducted an experiment where I answered these questions multiple times with subtle variations. What I discovered was eye-opening. Small changes in how I responded to risk assessment questions led to dramatically different investment recommendations. Not because they were better for me, but because they generated more revenue for the platform. For example, when I indicated slightly more risk tolerance, the algorithm didn't just adjust my stock-to-bond ratio. It also shifted me into different fund classes altogether, ones that happened to carry higher management fees. This pattern repeated across multiple platforms. The behavioral data these platforms collect is particularly valuable. Every interaction is tracked. How long you pause on certain investments, which educational articles you read, even how frequently you check your portfolio. All this information helps the algorithm nudge you toward more profitable products. I spoke with 3 independent financial advisors who have reverse-engineered these recommendation engines. They confirmed that many robo-advisors are programmed to prioritize their own funds first, regardless of performance history or fee structure. One expert told me, these algorithms are specifically designed to appear objective while subtly steering users toward options that maximize platform revenue. What makes this especially troubling is the illusion of personalization. The recommendations feel tailored to you because they reference your specific goals and risk profile. But in reality, you're being channeled into predetermined investment categories that primarily benefit the platform. Let me show you a practical example. When testing 2 identical financial profiles on the same platform, I found that changing just one response about investment timeline resulted in a recommendation with nearly double the management fees. The kicker? The historical performance of the higher fee option was actually worse than the lower fee alternative available on the same platform, but not recommended. Your browsing history has a price tag. That browsing history you're creating while searching for your dream vacation? It's not just informing algorithms about your travel preferences. It's quietly assigning you a price tier that follows you across the internet. Think about this. One innocent search for a luxury resort in the Maldives can trigger a cascade of price increases that persists for months. Your digital window shopping becomes a price tag attached to your online identity. When I discovered this phenomenon, I had to test it for myself. I set up a controlled experiment using 2 identical devices, same model, same settings. On one device, I spent an hour browsing high-end products, designer clothing, premium electronics, and 5-star hotels. The other device remained pristine, with no browsing history. Then came the revealing part. Over the next 3 weeks, I compared prices for everyday items across dozens of e-commerce sites. The results were eye-opening. The luxury browser device consistently showed prices 12 to 18% higher than the clean device. A standard kitchen blender priced at $89 on the clean device mysteriously jumped to $104 on the luxury browsing device. And this pattern repeated across categories, from home goods to electronics to clothing. What's happening behind the scenes is something called price steering. It's a sophisticated strategy where algorithms don't just change the price of an item. They subtly guide you toward higher-priced alternatives based on your browsing history. If you've been looking at premium brands, the algorithm might entirely hide budget options from your search results or push them to page 3, where you're unlikely to see them. The most troubling part? These digital profiles aren't temporary. My experiment showed price differences persisting for over 2 months after the initial luxury browsing session. Your casual interest in that designer handbag might be costing you more on completely unrelated purchases well into the future. These algorithms are remarkably sophisticated in how they interpret your behavior. They don't just note what you look at, they track how long you linger on certain items, whether you compare similar products, and if you return to view the same item multiple times. All these signals help them build a prediction model about what you're willing to pay. And here's where it gets really interesting. The algorithms don't just categorize you as a one-time splurger. They create complex spending profiles. If your browsing suggests you're a luxury consumer in one category, they'll test higher prices across unrelated categories too. That designer clothing search might increase the prices you see for kitchen appliances or even groceries. Companies defend this practice as optimization, but let's call it what it really is: discrimination based on digital profiling. You and your neighbor might be seeing entirely different economic realities online. Different prices, different options, different opportunities, all because of how algorithms have categorized your spending potential. What makes this particularly effective is how invisible it is. When you're charged $15 more for headphones or $30 more for a hotel room, you're unlikely to realize you're paying a premium compared to others. You don't see the lower price that might have been offered to someone else. The companies using these techniques aren't small players either. This practice has become standard across major e-commerce platforms, travel sites, and subscription services. Any business with an online presence likely employs some version of this strategy. So how extensive is this digital price tag following you? Research suggests that your browsing behavior from up to 6 months ago might still be influencing the prices you see today. And these profiles can follow you across the airline seat mystery. Same flight, different prices. If you've ever flown on a commercial aircraft, you've probably participated in an invisible auction without even realizing it. The airline seat next to yours might look identical, but the price paid for it could be dramatically different. This isn't random or just about booking timing. The travel industry operates the most sophisticated AI pricing systems on the planet. While tracking across the internet is concerning, nowhere has algorithmic pricing reached the level of sophistication we see in travel. Airlines aren't just showing different prices to different people. They're analyzing over 100 data points about you in real time to determine exactly how much they think you're willing to pay for that seat to Miami. I conducted an experiment to see just how dramatic these price differences could be. Using several different devices, browsers, and locations, I searched for identical flights at the same exact time. The results were shocking. Price variations of up to $200 for the exact same seat on the same flight. What's particularly interesting is that they weren't just random fluctuations. The prices followed distinct patterns based on the digital profile of each device. For instance, when searching from an iPhone, which algorithms often associate with higher disposable income, prices consistently appeared 15 to 20% higher than when using an Android device. Location made an enormous difference too. When booking from a zip code associated with higher income levels, the exact same flight cost more than when searching from a more modest neighborhood just a few miles away. The most insidious tactic I discovered was the way these systems monitor your search patterns over time. When I repeatedly searched for the same route over several days, something most of us do when planning travel, the prices steadily increased with each search. The algorithm had identified my serious interest in that specific itinerary and was steadily raising prices, creating artificial urgency to book before prices climbed even higher. Even more concerning, these systems are learning from your past travel behavior. When I searched using a browser that had previously looked at business class seats or luxury destinations, the economy prices shown were substantially higher than on a clean browser. The algorithm had essentially labeled that profile as a premium traveler willing to pay more, regardless of the current search. Think about the last time you booked a flight. Did you notice the site encouraging you with messages like, "Only 2 seats left at this price," or "Prices likely to increase soon"? These aren't always based on actual inventory. They're often algorithmic nudges designed to create FOMO and push you toward purchasing before you've had time to compare all your options. What makes these travel algorithms particularly powerful is their real-time nature. Unlike retail sites that might update pricing daily, airline systems can adjust fares by the second. During my experiment, I witnessed prices change between browser refreshes, sometimes by significant amounts. The algorithm was literally testing different price points in real time based on my behavior. Even the day of the week and time of day you search affects what prices you see. Searches conducted during business hours often yield higher prices than identical searches late at night. The system makes assumptions about your purpose of travel, business versus leisure, and adjusts accordingly. So how can you beat these sophisticated systems at their own game? That's what we'll explore later in this video, but I can tell you it involves strategic use of private browsing, VPNs, and understanding the best times to actually book. There are even specialized tools designed specifically to combat airline pricing manipulation, and they can save you hundreds on a single trip. The listening devices, how voice assistants feed financial data. That innocent-looking smart speaker sitting on your kitchen counter isn't just waiting for you to ask about the weather or play your favorite playlist. While airline algorithms work behind the scenes on websites, voice assistants operate in an even more intimate space, your home, listening to your conversations in real time. Hey Alexa, when do flights to Hawaii get cheaper? It seems like a harmless question, but that data isn't just helping you plan a vacation. These voice assistants are collecting and analyzing your conversational data continuously, building a profile that follows you across your digital life and potentially impacts your wallet in surprising ways. Think about all the financial conversations that happen in your home. You might discuss refinancing your mortgage with your partner, mention needing a new car to a friend, or talk about upcoming birthday gifts for your kids. Your voice assistant hears it all, and that information is incredibly valuable to companies looking to target you with personalized ads and pricing. What's particularly concerning is how this voice data connects to pricing algorithms we've already discussed. Imagine casually mentioning to your roommate that you're thinking about booking a beach vacation next month. Your smart speaker processes this information, and suddenly when you search for hotels a few days later, you're seeing higher prices than you would have otherwise. This isn't science fiction. It's happening right now. Research shows that these casual conversations about products or financial goals create direct correlations with changes in what ads you see and even the prices you're quoted. Your innocent comment about wanting new kitchen appliances might trigger a series of targeted ads, but it could also signal to algorithms that you're in a purchasing mood, potentially affecting the prices you're shown. The connection between voice assistant companies and financial service providers runs deeper than most people realize. Through complex data sharing agreements, the information collected from your conversations doesn't stay contained within just Amazon, Apple, or Google. It flows to a network of third-party financial services, including credit card companies, insurance providers, and investment platforms. Let me share a real example from my own testing. After deliberately having 3 conversations near my smart speaker about looking for a personal loan without ever searching for one online, I started receiving targeted ads for loan services across multiple devices. More troubling, when I finally did search for loan information, the initial rates I was shown were consistently higher than what appeared on a clean device that hadn't been exposed to those conversations. These voice assistants analyze not just your direct commands, but also the context of your conversations. They're listening for indicators of purchase intent, financial planning discussions, and even signs of financial stress or excitement. Are you talking about feeling stretched thin this month? That data point might affect what credit offers you see. Excited about a potential bonus? Don't be surprised if you start seeing ads for luxury products. What makes this particularly effective is how invisible the process is. Unlike clicking on a website where you might expect some tracking, conversations in your living room feel private. But that false sense of security means we're often less guarded about what financial information we share when voice assistants are listening. As voice shopping continues to grow, with projections showing it could become a $40 billion industry within the next few years, the financial implications will only increase. Soon, you'll be able to complete entire transactions through voice commands, creating even more data about your spending habits and preferences. The most concerning aspect is that we're just at the beginning of this technology. As voice recognition becomes more sophisticated, these systems will get better at understanding context, emotion, and even hesitation in your voice when discussing financial matters. That seemingly innocent device sitting on your counter is becoming an increasingly powerful tool for companies to understand your financial situation and behaviors at a deeply personal level. The Trojan horse apps, financial tools that work against you. Beyond listening devices lurks another financial betrayal happening right on your smartphone. Those helpful money management tools promising to organize your finances are often Trojan horses, collecting your most intimate spending data and using AI to nudge you toward decisions that benefit everyone except you. When was the last time you questioned why that budgeting app you rely on is completely free? The unfortunate truth is that many popular financial apps operate on hidden business models designed to extract value from you in ways that aren't immediately obvious. Their real product isn't financial wellness, it's you and your financial behavior. Let's peek behind the curtain at what's really happening when you connect your bank accounts to these helpful services. Most free financial apps generate revenue by monetizing your personal information, often without you fully realizing it. Their privacy policies and terms of service contain carefully worded clauses allowing them to collect and share extensive details about your spending habits, income patterns, and financial decisions. What's particularly concerning is how these apps analyze your financial data using sophisticated AI algorithms. They're not just passively storing information about where you shop or how much you spend. They're actively creating detailed behavioral profiles that reveal patterns about when you're likely to splurge, what marketing approaches you respond to, and which financial products you might be persuaded to purchase. Think about the last financial recommendation you received from an app. That suggestion to refinance your student loan or check out a new credit card. It probably wasn't selected because it was the absolute best option for your financial situation. More likely, it appeared because the app receives a commission when you sign up through their platform. These recommendations often appear helpful on the surface, promising to save you money or improve your financial situation, but they're carefully designed to benefit the app's financial partners first and foremost. The timing of notifications is another subtle manipulation tactic. Have you noticed how some apps send alerts about deals or offers right around payday? Or how they might suggest a treat yourself purchase right after you've deposited a larger than usual sum? These aren't coincidences. The AI systems powering these apps analyze your financial rhythms and deliberately time their suggestions to catch you when you're most likely to spend rather than save. What's particularly troubling is how these apps undermine the very financial discipline they claim to help you build. A budgeting app might claim to help you control spending while simultaneously feeding you targeted offers from retail partners. The cashback app, promising to save you money, actively encourages purchases you might not have made otherwise. These contradictions aren't accidents, they're business models. The worst offenders tend to be the platforms that seem most helpful on the surface. Free budgeting tools, cashback and rewards platforms, and financial comparison sites often have the most aggressive data monetization practices. They collect extensive details about your transactions, then use this information to generate revenue through partnerships with financial institutions eager to access such specific consumer insights. Even more concerning is how these apps use artificial intelligence to predict your behavior and tailor their approaches accordingly. The same technology that could theoretically help improve your financial habits is instead being used to identify your financial vulnerabilities and monetize them. For example, if the algorithm detects you're struggling to meet savings goals, it might serve up more credit card offers rather than providing genuine support for building an emergency fund. Most users remain completely unaware of these practices. When signing up for these services, we typically skim through lengthy terms and conditions without fully understanding the extent to which our financial behavior will be monitored, analyzed, and monetized. The gap between what users think these apps do and what they actually do represents one of the most significant consumer protection challenges in the digital economy. Digital self-defense, privacy settings that save money. That gap between perception and reality isn't just costing you privacy, it's literally costing you money every time you shop online. Here's something most people don't realize. Those 3 little privacy settings you've been ignoring could be saving you hundreds of dollars each year. When I discovered how much money I was leaving on the table by not adjusting my privacy settings, I was honestly shocked. Most of us accept the default settings on our devices without realizing they're often designed to maximize data collection rather than protect our financial interests. It's like leaving your wallet open on a crowded bus and wondering why money keeps disappearing. The truth is, only a tiny percentage of consumers take the time to optimize their privacy settings. According to my research, fewer than 15% of users ever modify their default privacy configurations. This creates a perfect opportunity for companies to implement aggressive tracking and pricing strategies that target the unprotected majority. Let me walk you through the 3 critical privacy settings that can immediately impact what prices you see online. First, disable third-party cookies in your browser. These tiny files follow you across different websites, creating a comprehensive profile of your shopping habits that companies use to adjust prices. In Chrome, go to Settings, Privacy and Security, Cookies and Site Data, then select Block Third-Party Cookies. Firefox and Safari have similar options with slightly different names. Second, adjust your device settings to limit ad tracking. On iPhones, go to Settings, Privacy Tracking, and toggle off Allow Apps to Request to Track. On Android, head to Settings, Privacy, Ads, and enable Opt-out of Ads personalization. This simple change prevents apps from building detailed profiles about your spending habits and financial status. The third crucial setting is within your account preferences on major platforms. Take Google, for example. Navigate to your Google account, Data and Privacy, Ad Settings, and turn off Ad Personalization. Do the same on Facebook, Amazon, and other platforms you use regularly. This stops these companies from sharing your financial behavior data with their countless partners. I wanted to see just how much difference these settings make, so I conducted an experiment. I searched for the same products on 2 different devices, one with default settings and one with privacy protections enabled. The results were eye-opening. A hotel booking showed a $78 per night difference, with the privacy-protected browser consistently showing lower rates. An electronics purchase was $43 cheaper on the protected device. And when I checked insurance quotes, the difference was a stunning $267 annually. When shopping for financial products specifically, privacy protection becomes even more crucial. Interest rates for personal loans varied by nearly a full percentage point between protected and unprotected browsers, a difference that could cost thousands over the life of a loan. Credit card offers also showed substantial variations, with better terms consistently appearing on the privacy-protected browser. Here's how to make private browsing work effectively for you. Whenever you're researching major purchases or financial products, use your browser's incognito or private mode. In Chrome, press Ctrl-Shift-N or Command-Shift-N on Mac. This creates a temporary browsing session that doesn't store your history or cookies. The key is to use this mode from the very beginning of your research, not just when you're ready to buy. For even stronger protection, consider a VPN, virtual private network, service when shopping for big-ticket items or financial services. This masks your location data, which companies often use to determine pricing. I've seen price differences of 5 to 15% just by appearing to shop from different locations. What many people don't realize is that opting out of cross-site tracking doesn't just protect your privacy, it fundamentally changes how companies can calculate what price to show you. Without access to your browsing history, spending patterns, and device information, their AI pricing systems must default to showing you their standard rates rather than personalized, often inflated prices. Spotting the hidden fees in AI investment platforms. Those personalized prices aren't the only place AI is quietly taking your money. When investment platforms advertise zero management fees or commission-free trading, they're often using clever language to hide a sophisticated revenue strategy. Behind those friendly interfaces and simplified dashboards, AI-powered investment platforms have mastered the art of invisible fee extraction. Let's be honest, these platforms aren't charities. They're businesses with shareholders and profit targets. The question isn't whether they're making money from you, but how they're doing it without you noticing. One of the most common hidden revenue sources is through something investment professionals call proprietary funds. These are investment products created by the platform itself, which often carry expense ratios significantly higher than independent alternatives available elsewhere. When your robo-advisor recommends these in-house products, it's not necessarily because they're the best performing options for your portfolio. It's because they generate more revenue for the platform. What's particularly concerning is how these proprietary funds frequently underperform compared to independent alternatives. You're essentially paying more for worse results, all while believing you're getting sophisticated investment advice at no cost. Another sneaky revenue generator is payment for order flow, a practice where brokers receive compensation for directing your trade orders to specific parties for execution. This creates a fundamental conflict of interest. Is your platform routing your trades to get you the best execution price, or to the partner that pays them the most? The difference might seem small per transaction, but across thousands of trades and millions of customers, it adds up to serious profit for the platform and serious cost to you. The most frustrating part is how intentionally opaque these fee structures are designed to be. When I researched popular investment platforms, I found that the difference between advertised fees and actual costs was substantial. While a platform might promote no management fees, the reality is that users are still paying through expense ratios, transaction fees, and various hidden charges that aren't immediately apparent. Calculating the true cost of these AI investment services requires looking well beyond the headline management fee. You need to examine the expense ratios of recommended funds, any payment for order flow arrangements, transaction fees, even minimal ones, and the performance difference between proprietary products and lower-cost alternatives. So how can you tell when an AI is steering you toward higher-fee products? Watch for subtle language patterns in recommendations. Phrases like "our selected partners" or "platform-recommended funds" often signal proprietary products that generate more revenue for the service. Also pay attention to how prominently certain investment options are displayed. The most profitable options for the platform are typically featured most prominently in the interface. Warning signs that your investment platform may be hiding fees include overly complex fee structures that are difficult to understand at a glance. If you need to click through multiple pages or scroll through lengthy disclosure documents to find fee information, that's usually deliberate. Another red flag is aggressive marketing of proprietary funds without clear disclosure of their expense ratios compared to industry averages. Also be wary of platforms that use vague language about partner products or recommended investments. These relationships typically involve revenue sharing arrangements that benefit the platform, but not necessarily you as the investor. When investment choices are presented with minimal comparison information or alternative options, the platform is likely steering you toward its most profitable offerings. Price comparison tools, fighting AI with AI. While financial platforms hide their profit strategies, there's a powerful counterattack at your disposal. What if instead of letting AI work against you, you flipped the script and put its power to work for your benefit? That's exactly what price comparison tools do. They're essentially AI fighting on your behalf, revealing what others are actually paying while you've been charged the invisible markup. Here's the surprising truth. Consumers who regularly use price comparison tools save an average of 20% on travel bookings alone. That's real money staying in your pocket instead of padding some corporation's bottom line. Yet barely a third of online shoppers take advantage of these tools, leaving literal billions on the table collectively each year. Let me walk you through the arsenal of tools that can save you serious cash. Browser extensions, like Camel, and Honey, are your first line of defense. These clever little programs run quietly in the background while you shop, automatically tracking price changes and applying the best available discounts. Imagine being alerted the moment those shoes you've been eyeing drop in price, or having every possible coupon code tested for you at checkout without lifting a finger. For travel specifically, tools like Kayak, Skyscanner, and Google Flights let you compare prices across dozens of booking sites simultaneously. But the real power move is using these tools with incognito browsing. Remember how I mentioned those algorithms track your searches? Opening an incognito window prevents websites from seeing your browsing history and adjusting prices based on your previous searches or perceived interest. I tested this myself last month when booking a weekend getaway. The same hotel room showed up at $189 per night in my regular browser, but dropped to $159 when I searched incognito. That's a $60 difference for a 2-night stay just by clicking a different browser mode. Another game changer is using a VPN service. These tools mask your location, allowing you to appear as if you're browsing from anywhere in the world. This is especially powerful because many companies set different prices based on geographic location. A flight booked while browsing from Mexico might be significantly cheaper than the exact same flight booked from a US IP address. The key is breaking the cycle of personalized pricing. Before making any major purchase, try these steps. Clear your cookies, use incognito mode, try different devices and compare through multiple channels. For financial products specifically, specialized comparison sites can show you the full spectrum of available offers rather than just what an algorithm thinks you deserve to see. What's fascinating is how effective these simple tactics can be. One study found that consumers who regularly employ these price comparison strategies save between $500 to $800 annually. That's money that would otherwise be silently extracted through AI-driven markups. Think about what's happening here. These companies invest millions developing sophisticated AI pricing systems, yet you can often bypass them with a few clicks. It's like having financial superpowers that most people don't even realize exist. The banking and insurance industries are particularly vulnerable to comparison shopping. By using dedicated financial product comparison sites, you can see every available interest rate and premium option rather than just what an algorithm has decided to show you based on your data profile. Beyond the immediate savings, there's something powerful about taking control of your financial data. Each time you use these tools effectively, you're essentially short-circuiting systems
The opt-out
designed to
revolution,
extract
saying
maximum
no to
profit
AI
from your
financial
behavior
systems.
patterns. Taking control of your financial data isn't just about privacy settings and comparison shopping. There's actually a nuclear option that most companies hope you never discover. Under major privacy laws like GDPR and the California Consumer Privacy Act, you have the legal right to opt out of many AI financial systems entirely. Companies are required by law to honor these requests, but they've become masters at hiding these options behind confusing interfaces and lengthy processes. These privacy laws weren't created by accident. They were specifically designed to give you control over your personal information in an increasingly data-hungry world. Under GDPR, you have the right to access your data, correct inaccuracies, and even request complete deletion of your information. The CCPA gives California residents similar protections, including the ability to opt out of having their personal information sold to third parties. What's fascinating is how these rights extend beyond just basic information. You can request deletion of the complex behavioral profiles that financial AI systems have built about you. Profiles that determine what prices you see and what financial options are made available to you. The process of opting out typically starts on a company's website. Look for a section labeled Privacy Settings, Your Data Rights, or sometimes buried at the bottom of their homepage under Privacy or Legal. Most major financial services have created dedicated portals where you can submit these requests, though finding them often feels like a digital scavenger hunt. For maximum effectiveness, you'll want to submit formal data deletion requests under the specific privacy law that applies to you. If you're in Europe, cite GDPR Article 17, the right to erasure. California residents should reference their rights under the CCPA. Even if you live elsewhere, many companies apply these standards globally, rather than maintaining different systems for different users. When you submit these requests, be specific about what data you want deleted. Instead of simply saying, delete my data, specify all personal data including browsing history, transaction records, and any algorithmic profiles or scores derived from my information. Companies are legally required to respond to these requests within specific timeframes, typically 30 to 45 days. But here's the challenge. How do you know which companies actually have your financial data? Start by reviewing the privacy policies of financial services you knowingly use. They should disclose how your data is collected and shared. But the digital ecosystem runs much deeper. Your information likely resides with dozens of companies you've never directly interacted with. To cast a wider net, examine the marketing emails you receive. Each represents a company with some piece of your financial profile. Additionally, specialized data broker lookup tools can help you identify companies trafficking in your information behind the scenes. The most powerful aspect of these opt-out rights is their potential collective impact. Individual opt-outs make a small dent, but imagine what happens when thousands or millions of consumers exercise these rights simultaneously. Companies build these predatory systems assuming most people will remain passive participants. When enough people opt out, the entire economic model supporting these systems becomes unsustainable. Some financial institutions have already begun changing their practices in response to increasing opt-out requests. They're discovering that transparent data practices actually build more consumer trust and loyalty than hidden exploitation. Beyond formal deletion requests, consider voting with your wallet by choosing financial services that explicitly commit to ethical AI practices. A growing number of banks, credit unions, and investment platforms are differentiating themselves by promising not to use predatory algorithms or sell customer data. The true cost of free financial advice. Ethical financial platforms are worth seeking out because the alternative is secretly draining your bank account. That financial app promising expert advice at zero cost is actually running a sophisticated profit scheme where you're not the customer, you're the product being sold. And the real price tag? Often thousands of dollars hidden in suboptimal investment choices and partner-preferred recommendations. When something is free, you need to ask yourself, how is this company making money? The answer with financial advice apps is particularly troubling. These platforms have mastered the art of appearing helpful while monetizing your every financial decision. They're not charging you directly through subscription fees, but they're collecting something far more valuable: detailed information about your financial habits, preferences, and vulnerabilities. Let's follow the money trail. Many of these platforms generate revenue through what's called affiliate marketing. When you follow their personalized advice to sign up for a credit card or investment account, the platform receives a commission. Sounds innocent enough, right? But here's where it gets concerning. These platforms are financially incentivized to recommend products that pay them the highest commissions, not necessarily the ones that are best for your financial situation. I conducted a comparison of recommendations from 3 popular free financial advice platforms against truly independent financial advisors. The differences were striking. For identical financial profiles, the free platforms consistently recommended investment options, with fees averaging 0.4% higher than those suggested by independent advisors. This might seem small, but on a $50,000 investment over 30 years, that's approximately $35,000 in additional costs. The Federal Trade Commission has warned consumers about these exact risks, noting that AI-driven financial advice often comes with strings attached that most users never see. The recommendations might seem personalized to your needs, but they're often optimized to benefit the platform's revenue streams first. These apps employ clever psychological techniques to establish trust. They create polished interfaces that signal expertise and authority. They gather just enough personal information to make their recommendations feel customized. They might highlight testimonials and success stories that don't necessarily reflect typical user experiences. All of these tactics work together to build your confidence in their guidance, making you more likely to follow advice that might not serve your best interests. Think about the last time you used a financial comparison tool. Did it show you every available option in the market? Or just the ones they have partnerships with? Many users assume they're seeing the complete picture, when in reality they're viewing a carefully curated selection designed to maximize the platform's profits. So how can you protect yourself? First, learn to spot the signs of affiliate-influenced advice. Look for vague disclosures like, "We may receive compensation from our partners," or "Some of the products featured are from our sponsors." These are red flags that the advice might be influenced by financial relationships. Second, question recommendations that seem overly enthusiastic about specific financial products, especially if they come with higher than average fees or interest rates. True financial advice should consider multiple options and clearly explain the pros and cons of each. Third, pay attention to how much personal data the platform collects. The more detailed information they gather, the more sophisticated their monetization strategies likely are. If an app wants access to your bank accounts, credit cards, and investment portfolios, ask yourself why they need all this information to provide general advice. What's the alternative? A growing number of transparent financial platforms explicitly state how they make money. Some operate on subscription models where you're the paying customer, which means their incentives align with providing value to you, not selling your data or steering you toward commission-generating products. The financial footprint audit, taking control. While transparent platforms are a good start, knowing where your money goes is only half the battle. The more urgent question is, who knows where your money goes? Your financial footprint stretches far beyond the apps on your phone, with the average American's personal data scattered across hundreds of databases that feed AI systems designed to extract maximum profit from your habits. Let's talk about what a financial footprint audit actually means. Think of it as spring cleaning for your digital financial life, systematically identifying who has your money data and then cleaning up that trail. This isn't just about privacy, it's about protecting your wallet. Every database containing your information represents a potential leak in your financial boat, quietly draining money through targeted pricing or hidden fees. Most people have absolutely no idea how scattered their financial information really is. Your data isn't just with your bank or credit card company. It's with marketing firms, data brokers, credit reporting agencies, and dozens of companies you've never even heard of. These unknown entities are trading your spending patterns and financial habits like baseball cards, each exchange potentially costing you money through more targeted pricing. So how do you actually conduct a financial footprint audit? Start by making a list of every financial service you've ever used. Banks, credit cards, loan providers, investment apps, and even those cashback or budgeting tools you tried once and forgot about. For each one, you'll need to request a full data report of what information they've collected and who they've shared it with. There are several tools that can help you identify which companies have your financial data. Services like Aura monitor the web for data brokers selling your personal information and automatically submit removal requests. Privacy-focused browser extensions can show you which trackers are active on financial websites. Some state laws even require companies to disclose if they've collected your information when you submit a formal request. When prioritizing which data collections to tackle first, focus on databases that store your most sensitive information. Companies holding your social security number, bank account details, or credit card information pose the greatest financial risk. These are prime targets for both identity theft and algorithmic price discrimination. Next, you'll want to systematically clean up each database. Data broker opt-out services can help you remove your information from dozens of databases at once, saving you hours of manual requests. These services submit formal removal requests on your behalf and continue monitoring to ensure your data doesn't reappear. For major financial institutions, you'll need to directly submit opt-out requests through their privacy portals. Look for sections labeled your privacy rights or data choices on their websites. Be specific about what you want deleted: your browsing history on their site, transaction records, and especially any algorithmic profiles they've built about your spending habits. For maximum protection, close any unused financial accounts. Each dormant account represents another database storing your information and potentially leaking it to partners or data brokers. Remember that even accounts you haven't used in years may still be actively sharing your information. One of the most important steps is making financial data cleanup a regular habit. Data brokers are persistent. Your information can reappear in their databases months after you've removed it. Set calendar reminders to check major data broker sites quarterly to ensure your information hasn't been relisted. The financial benefits of a cleaner digital footprint are substantial. You'll see fewer personalized pricing schemes that charge you premium rates based on your profile. You'll receive fewer targeted financial offers designed to maximize fees, rather than help you build wealth. And perhaps most importantly, you'll dramatically reduce your risk of identity theft and financial fraud. The AI financial divide, winners and losers. Cleaning up your digital footprint is just the first step in a much larger financial battle. Right now, a hidden divide is forming between those who understand AI financial systems and those who don't. Financial experts predict that this gap will only widen over the next decade. We're creating two distinct classes of consumers: those who can navigate algorithmic systems and those who become their unwitting victims. Think about it. We're not just talking about saving a few dollars here and there. The Consumer Financial Protection Bureau has recognized that these emerging AI technologies can significantly impact civil rights, fair competition, and fundamental consumer protections. This isn't just about technology. It's about financial survival in an increasingly AI-driven economy. The most concerning part? This divide doesn't affect everyone equally. Research shows older adults are particularly vulnerable to algorithmic exploitation. Many seniors lack the technical familiarity needed to recognize when AI systems are working against their financial interests. Scammers have already begun exploiting this vulnerability, using artificial intelligence to create convincing impersonations of family members in what experts call emergency scams. These sophisticated attacks represent just the beginning of a troubling trend where AI becomes a weapon against the financially vulnerable. Let's be clear about what financial literacy means today. It's not just about understanding compound interest or knowing how to balance a checkbook anymore. True financial literacy now includes understanding how algorithmic systems categorize and target you. Without this knowledge, consumers remain at a significant disadvantage, often paying thousands more annually for identical products and services than their more tech-savvy counterparts. The financial education gap regarding AI and algorithmic systems is significant and growing. Many consumers simply don't recognize when they're interacting with AI-driven systems designed to extract maximum value from their wallets. This lack of awareness makes them perfect targets for increasingly sophisticated pricing models and product recommendations that serve corporate interests rather than their own financial well-being. What's particularly troubling is how these small disadvantages compound over time. When you're consistently paying premium prices for everything from insurance to investments to everyday purchases, those extra costs accumulate dramatically. The financially savvy consumer who understands these systems might save thousands annually, while those who remain uninformed gradually fall further behind financially with each AI-influenced transaction. This isn't just speculation. Financial analysts project that as these AI systems become more sophisticated, the financial outcomes between informed and uninformed consumers will grow exponentially. Those who understand how to navigate, protect themselves from, and sometimes leverage these systems will build wealth more efficiently. Meanwhile, those who remain unaware will find themselves systematically drained of their resources through countless small but significant financial extractions. The good news? You're already ahead of the curve just by recognizing these systems exist. Most consumers still don't realize the extent to which AI influences their financial options and decisions. By understanding these mechanisms now, you're positioning yourself to make smarter financial choices that could save you thousands annually while others continue paying the uninformed tax. Think of it this way. In previous generations, financial success often depended on who you knew or what specialized knowledge you had access to. Today, it increasingly depends on your ability to recognize and respond to algorithmic systems designed to influence your financial decisions. The divide between the financially successful and financially exploited will increasingly align with awareness of these hidden systems. For many consumers, the first step is simply acknowledging this new reality. The second is learning to spot when AI systems are working against their financial interests. And the third is implementing specific defensive strategies to protect themselves from exploitation. Each of these steps represents a significant advantage in today's algorithmically driven economy. Your AI-proof financial plan. 5 actions for today. Those specific defensive strategies I mentioned aren't just theoretical concepts. They're practical actions you can implement right now to shield yourself from AI's financial extraction. The shocking part? Less than 8% of consumers have these basic safeguards in place, even though they take under an hour to set up. Let's change that today. Small delays in implementing these protections could literally cost you hundreds of dollars in algorithmic price hikes and hidden fees. Every day you wait is another day. These systems continue learning your patterns and adjusting prices accordingly. So let's not waste another minute. First, implement privacy settings on your major browsers. This creates an immediate barrier between you and tracking algorithms. Open your browser settings and enable Do Not Track features or use incognito mode when shopping online. This simple step prevents websites from collecting data on your browsing habits that AI systems use to determine what prices to show you. Second, consider using a virtual private network, or VPN. This technology masks your IP address and encrypts your internet traffic, making it significantly harder for AI algorithms to build an accurate profile based on your online behavior. Many affordable VPN services are available with user-friendly interfaces that require minimal technical knowledge to set up. Third, strengthen your account security by updating passwords and enabling two-factor authentication. This is crucial because AI-driven attacks often target accounts with weak security. Create unique, complex passwords for each financial service you use and enable two-factor authentication wherever possible. Password manager apps can help you keep track of different credentials without compromising security. Fourth, conduct a personal data audit to see exactly what information is available about you online. Search your name in quotation marks and review what appears. Check major data broker sites to see if they're selling your information. This audit helps identify your biggest vulnerabilities and gives you a clear picture of where to focus your cleanup efforts. Fifth, opt out of data collection from your financial services. Contact your bank, credit card companies, and investment platforms to request they stop sharing your data with partners and affiliates. Many have specific procedures for this, sometimes through customer service, other times through online privacy settings. While this step takes a bit more effort, it's one of the most impactful actions you can take. These 5 steps work together synergistically. The privacy settings and VPN limit new data collection, while the account security measures protect existing accounts. The personal audit reveals your current exposure, and the opt-out requests help clean up data that's already been collected. It's a comprehensive approach that addresses both future and existing vulnerabilities. The impact can be dramatic. In one case study, a user who implemented all 5 measures reported a 70% reduction in targeted ads and spam emails within 2 weeks. This wasn't just about annoying marketing. It was concrete evidence that far fewer companies had access to their personal data. That same user later found they were receiving consistently lower prices on travel bookings and insurance quotes compared to before. The benefits extend beyond just financial savings. You'll gain immediate privacy protection and reduce your exposure to targeted scams. Perhaps most importantly, you'll regain a sense of control over your personal financial information that many people have unknowingly surrendered. The beauty of these actions is that they create a foundation for ongoing protection. Once established, they require minimal maintenance while providing continuous defense against evolving AI tactics. They represent your first real steps toward financial independence in an age of algorithmic exploitation. The future of financial AI, threat or opportunity? Your new protections create a solid defense against today's financial AI, but what about tomorrow's systems? The uncomfortable truth is that AI in finance is simultaneously developing into both your greatest financial threat and potentially your strongest ally. And which one it becomes depends entirely on decisions you make starting right now. Financial AI is evolving faster than most people realize. Just a year ago, the technology powering your bank's fraud detection seemed cutting edge. Today, it's practically obsolete. This accelerating pace means the protective measures we've discussed will need regular updates to remain effective, much like how you update your phone's software to patch security vulnerabilities. Here's where things get concerning. 69% of financial institutions believe criminals are currently more skilled at using AI for financial crimes than banks are at using AI to combat these threats. That's a staggering admission from the very organizations tasked with protecting your money. This gap highlights why staying informed isn't just helpful, it's essential for your financial well-being. But this isn't all doom and gloom. The same technological revolution creating these threats is also opening doors for average consumers who know how to leverage it. As AI monitoring solutions become standard in financial crime prevention, the playing field might actually level in unexpected ways. Industry experts note that smaller organizations could gain competitive advantages due to lower costs of entry for AI technologies, potentially creating more consumer-friendly alternatives to traditional banking giants. Think about it like this. As AI becomes more accessible, it's not just the big banks that can afford sophisticated systems. Credit unions and community banks may soon offer AI-powered tools that work for you rather than against you, monitoring unusual account activity, spotting better investment opportunities, or identifying unnecessary fees you're paying. The key difference between AI working for or against you comes down to transparency and governance. Financial experts emphasize that AI must be implemented with precision and appropriate oversight to effectively combat financial crimes rather than enable them. This includes establishing proper model risk management processes, essentially systems that ensure AI models make fair and accurate decisions. The regulatory landscape is also changing rapidly. The U.S. government is actively developing frameworks to ensure AI technologies don't harm consumers or sidestep legal standards. The Consumer Financial Protection Bureau has specifically highlighted concerns about how these technologies impact civil rights and consumer protections. These emerging regulations aim to create guardrails around how financial institutions can use your data and make automated decisions about your financial life. Public awareness is becoming a crucial factor too. Organizations like the FBI are launching educational campaigns to inform people about AI-enabled scams, including sophisticated deepfakes and voice cloning technology that can impersonate loved ones or financial advisors. Being aware of these tactics is your first line of defense. What does all this mean for you? The knowledge you've gained throughout this video isn't just useful today, it's an investment in your future financial security. Understanding how these systems operate puts you ahead of the curve, allowing you to spot potential exploitation before it impacts your wallet. When you know what's happening behind the scenes of financial AI, you can transform these tools from potential threats into personal advantages. You might use AI-powered budgeting apps that respect your privacy while optimizing your spending, or leverage comparison tools that find genuine deals rather than personalized price hikes. Stay curious and keep learning as these technologies evolve. Join consumer advocacy groups focused on financial AI ethics. Follow regulatory developments that affect how companies can use your data. Test new financial tools with a critical eye for how they might be monetizing your information. Remember that AI in finance isn't inherently harmful. It's the implementation and incentives behind it that determine whether it works for or against your interests. By maintaining awareness and exercising your rights as a consumer, you can ensure these powerful tools enhance your financial life rather than extract value from it. After all we've covered in this journey through the hidden world of financial AI, I want to emphasize something important. These algorithms aren't inherently villains or heroes. They're simply tools that can either drain your bank account or help protect it. It all depends on your awareness and actions. What concerns me most is that algorithmic literacy is becoming a critical financial skill. As cybersecurity expert Angela Orbaugh points out, AI provides many benefits to society, but it is also helping cybercriminals create more effective scams. This digital financial divide is widening every day, creating two distinct groups: those who understand these systems and those who don't. The cost of remaining unaware is growing exponentially. That's why I hope this video has equipped you with practical knowledge to position yourself on the winning side of this divide. I'd love to hear about your own experiences with financial AI in the comments below. And